When the market gets scared, it almost never destroys value cleanly. It sprays fear across an entire sector, throws a blanket over all the names, and then dares you to tell the difference between a real casualty and a business that is simply trading at the wrong funeral. That is what I think happened here. A whole class of software companies got dragged into the street and repriced as if artificial intelligence had already signed their death certificate. The headlines were loud, the charts were ugly, the sentiment was violent, and as usual, the public started confusing a narrative shock with a business collapse. I have seen that movie before. The market loves taking a reasonable concern and converting it into a ridiculous conclusion. It begins with one true sentence. AI agents will absolutely change how software is used, sold, priced, and valued. That sentence is true. Then the market adds a false sentence. Therefore, most enterprise software businesses are worth dramatically less, perhaps permanently less, perhaps close to nothing, if you wait long enough. That sentence is where the real opportunity begins, because once that false sentence becomes popular enough, good businesses start trading as if they are broken when they are merely being misunderstood. That is where I start paying attention. The stock I want to talk about is not interesting because it is down a lot. Plenty of garbage goes down a lot. That is not a thesis. A low chart is not a moat. A violent decline is not a business model. What matters is whether the decline happened while the underlying company kept doing the hard, valuable things that real businesses do: growing, keeping customers, producing cash, moving upmarket, embedding itself more deeply into how its customers actually operate. That is a completely different story. The stock is Monday.com, and if you only look at the drawdown, you will miss the business. That is the trap. The stock is down enormously from its highs. That fact has become the story people tell themselves. They look at the chart, feel the pain through the screen, and then backfill a reason: must be broken, must be over, must have been a fad, must be one of those companies the world no longer needs because AI is coming for everyone. That is lazy thinking. The chart tells you what investors felt. The business tells you what customers are doing. Those are not always the same thing. And when they split far enough apart, the gap between feeling and reality can become a life-changing opportunity. Now let me tell you the real story as I see it. A lot of people talk about software as if it were simply code. Build the app, ship the interface, add some features, rent seats, charge monthly, repeat. That is how outsiders think about it because that is the easy part to understand. It is also the least valuable way to think about serious enterprise software. The software business that gets defended by customers is not just code. It is plumbing. That is the mother line here, plumbing. Not glamorous, not cinematic, not the thing retail investors put on a t-shirt. But if you have ever owned a business, you learn quickly that the most valuable systems are often the ones nobody brags about when they are working and nobody can function without when they break. That is what enterprise plumbing is. It is not the pretty layer. It is the layer beneath the pretty layer. The workflows, the handoffs, the integrations, the security structure, the audit trail, the permissions, the automations, the custom internal tools, the way one department talks to another without 20 people forwarding the same email chain around like school children. That is the real asset, and that is why I think the market got this whole sector badly wrong. The fear started for a reason. New AI products arrived, and suddenly the market imagined a future where agents could do the job of software itself. If an AI assistant can handle CRM tasks, project management, scheduling, workflow prompts, approvals, and updates, then maybe companies do not need as many software seats. Maybe they do not need as many licenses. Maybe the whole software as service model begins to unravel. That fear has logic. I understand the logic. I just do not think the conclusion follows, because building the first 2% of a software experience is not the same thing as replacing the 98% of enterprise plumbing underneath it. That distinction is enormous. AI can absolutely help build prototypes faster. It can speed up interface creation. It can automate repetitive actions. It can reduce friction in how people interact with systems. I expect all of that. But the market heard that and jumped to a fantasy in which the rest of the enterprise stack somehow ceases to matter. It does not. You can build a pretty front door in an afternoon. You cannot build 15 years of enterprise trust. Compliance, handling, reliability, permissions, structure, integrations, customer relationships, support history, and embedded workflow logic in an afternoon. That is what the market forgot. And when markets forget something important, prices can become very stupid very quickly. The software sell-off has been a beautiful example of this. Investors suddenly began treating the entire software sector as if all these businesses were one shallow layer of replaceable code. They were not asking which companies had real traction, which had enterprise stickiness, which had cash generation, which had room to pivot, which had product breadth, which had customer retention, and which had operating leverage. They just wanted out. Fear does that. It does not rank, it evacuates. Now this is where Monday becomes interesting. Monday was originally easy to dismiss because people heard the name and thought task management, maybe a prettier project board, maybe a productivity toy, maybe one of those tools teams like when they are small and then abandoned when the real work begins. That is not what it is anymore. Monday built what it calls a work operating system. I like that phrase because it points at the right thing. The point is not one feature. The point is not one board. The point is not one workflow. The point is that the product becomes a configurable layer companies use to run how work moves. That matters. A business is not just the output it sells to the world. It is also the invisible movement of work inside the business. Sales, marketing, development, support, approvals, tracking, reporting, handoffs. If all of that lives in isolated spreadsheets, scattered chat messages, random documents, and people's memory, you do not have a company. You have a collection of avoidable mistakes waiting for a calendar. Monday solved part of that, and then it kept widening the pipe. That is what I like. It started from project management roots. Yes, but now it stretches into CRM, software development, workflows, its service use cases, marketing operations, and a broader operating layer that customers can customize around their actual internal needs. That is not just software. That is embedded process. And embedded process is exactly the kind of thing enterprises do not casually rip out because a flashy new demo scared Wall Street for 6 weeks. Now let me get to the numbers because stories are nice, but numbers pay the rent. The company has kept growing paid subscriptions at a very healthy pace. Revenue growth has remained strong. The company keeps an extraordinary amount of gross profit for every dollar of sales, roughly 90 cents. That is a beautiful number in this business because it tells you the core engine has enormous room to fund product expansion, go to market effort, AI development, and strategic flexibility. This is one of the quiet advantages of software that the market suddenly started pretending did not matter. When you have a business with this kind of margin structure, you are not helpless in a technological transition. You have resources, you have flexibility, you have time, and time funded by high gross profit is often the difference between a business that adapts and a business that gets buried. Monday also has something else that mattered greatly to me when I read through the setup. Customers are staying. That is not a small point. If the AI fear were already translating into fundamental destruction, you would expect to see brutal deterioration in customer behavior. You would expect retention to crack. You would expect renewals to collapse. You would expect usage-based softness to spread across the customer base as buyers quietly stepped away. That is not what the numbers are telling you. The customers are still there. And not only are they still there, the company keeps winning larger enterprise contracts. Now that is where the real thesis moves from good to interesting. Small customers are nice. Large embedded customers are powerful. When a business starts landing bigger and bigger enterprise deals, especially in a platform business that customers can build on top of, the nature of the relationship changes. At that point, the software is no longer just rented functionality. It becomes part of the customer's internal architecture. They build processes around it. They build reporting habits around it. They train people around it. They connect it to other systems. They create workflows and custom tooling on top of it. Every layer they add makes switching harder, more expensive, and more politically annoying inside the organization. That is how enterprise plumbing becomes a moat. Not because nobody else can make a prettier interface, because replacing the thing would require ripping open walls, and companies hate ripping open walls unless they absolutely have to. This is why I think the market's conclusion is backward. The market saw AI and thought software gets replaced. I see AI and think companies with embedded plumbing can become distribution points for the next generation of software functionality. That is a completely different implication. If Monday were a weak low margin, one feature toy with churny users and no enterprise traction, then AI would be far more frightening in that world. The company would be trapped. But a platform company with deep integrations, high gross margins, growing enterprise relationships, and customer customization opportunities does not have to be the victim of AI. It can be a host for AI. That is exactly what the company is already trying to do, and that matters. Because when the market prices you as if technology is about to erase you, but in reality, technology is something you can incorporate into your own platform, the asymmetry becomes very attractive. This is the part many investors miss when they think about disruption. They imagine disruption as a clean event. Old category dies, new category wins, incumbents vanish, startups feast. That is a childish version of history. Real disruption usually looks messier. Some incumbents die. Yes, some get stronger. Some use their customer base, capital distribution, and product breadth to absorb the new technology faster than outsiders expect. The market rarely prices that transition properly in the middle of a panic. It prices the obituary. Monday, to me, is not priced like a profitable expanding software platform with product breadth, enterprise momentum, strong retention characteristics, and AI optionality. It is priced like an accusation. And accusation-priced assets can become very interesting. Now let me widen this story because I do not think you can understand Monday in isolation without understanding what happened to software. Generally, the sector got repriced violently. Over $2 trillion of market value disappeared across software names. Some of the most widely respected companies in the space fell hard: Oracle, Salesforce, Adobe, HubSpot, Monday. Others got absolutely obliterated. The important thing here is not that every one of those companies is equal. They are not. The important thing is that fear became so broad that investors stopped distinguishing between strong businesses and merely fashionable ones. That is when sectors create generational setups, not when they are simply down. When they are down for reasons broad enough to punish quality along with nonsense. I have watched this happen before. A technology scare arrives. The market extrapolates a new world too quickly. Multiples collapse. People say the old model is dead. Then a few months or quarters later, reality resumes being reality. Strong businesses keep producing cash. Customers keep renewing. The better operators adapt faster than the market expected. Acquirers show up, sentiment turns. And the same people who were explaining why the sector was uninvestable start explaining why the leaders are essential long-term winners. The public calls that a comeback. I call it the market noticing what was already true. There was a similar panic years ago in software. A lot of names got hit savagely. The claim then, too, was that the sector had lost its old magic, slowing spend. Pressure on growth, new competitive realities, same old funeral music. Then one major transaction changed the mood, sentiment snapped back, and strong software businesses spent years compounding for people who had the stomach to buy when the sector felt radioactive. That is how this works. The market never rings a bell that says the narrative has overshot. It simply hands you the opportunity and dares you to act while the room still smells like smoke. Now, I want to explain why Monday specifically seems so unusual to me in this environment. It is not just the business quality. It is the combination of business quality and emotional damage in the stock. That combination matters. A wonderful business at an absurd price can still be a bad investment. A damaged business at a cheap price can still be a disaster. What you want, if you can find it, is a real business with real proof of traction, real cash generation potential, real customer stickiness, and genuine avenues for future growth. But trading as if it belongs to a much weaker category, that is where the deal lives. Monday fits that pattern better than most people realize. It has multiple growth lanes that matters because single product stories are fragile. If one thesis fails, the whole structure collapses. A company with several ways to win does not need one perfect outcome. It needs continued competence across a widening platform. Monday has the project management roots. It has CRM, it has development, related use cases, it has its service applications, it has AI tooling and agent, related ambitions layered on top. That is not one narrow shot. That is a business with several on-ramps to customer value. When you combine that with healthy gross margins, strong subscription growth, meaningful customer retention, and enterprise traction, you get something very different from the cartoon version of Doom SaaS that the market has been shouting about. And then there is management. Guidance matters, not because I worship quarterly theater, I do not, but because markets often overreact to tone and then underreact to setup. When management sets the bar low enough in a panic environment, the future can become a series of beats against washed out expectations. That is one of the oldest ways a destroyed stock starts crawling back into respectability. Not through one giant miracle, but through a sequence of reality arriving better than fear had budgeted for. I think that possibility is real here. Now let me say something important so nobody misunderstands me. This is not a promise. It is not a guarantee. It is not a claim that Monday cannot fall more. Of course it can. The market is perfectly capable of making stupid prices even stupider in the short run. That is part of the cost of being early. If you buy something like this, you must accept that the market may insult you for a while before it rewards you. It may even insult you much more than you think is fair. That is not a flaw in the thesis. That is the tax you pay for buying quality before the crowd remembers what quality is. What protects you is not the price action. What protects you is the business. That is the real source of conviction. A lot of investors say they want asymmetric upside, but what they really want is asymmetric upside with immediate social validation. That is not how it usually arrives. Real asymmetry often looks embarrassing before it looks intelligent. It often comes wrapped in a drawdown large enough to make everybody around you question your sanity. That is why I keep coming back to the same phrase. Enterprise plumbing, if you understand that, the whole story becomes easier to hold. The company is not merely selling a feature, it is selling embedded work infrastructure. And embedded work infrastructure tends to survive narrative panics much better than the market initially believes. Now think about what happens if I am even partly right. I do not need every software company to recover. I do not need AI fears to disappear. I do not need the sector to go back to its wild old multiples. I only need the market to stop pricing Monday like a dead business and start pricing it like a still growing platform business with strong economics and several ways to adapt. That re-rating alone can be enormous. And if on top of that, the business keeps executing, if enterprise deals keep growing, if product breadth keeps expanding, if AI becomes an adoption tailwind rather than a replacement threat, then the upside can become the kind of thing people later call obvious. Nothing is obvious while the stock is being treated like roadkill. That is the point. This is why I think this one stock has the potential to change lives. Not because it is a lottery ticket, not because it is a meme, not because it is some zero revenue fantasy with a good story, because when a real business with real traction and real adaptability gets repriced as if the future has already excluded it, the rebound in truth can be enormous. That is the setup. Now, whether somebody should buy it depends on temperament as much as analysis. If you cannot handle volatility, do not pretend you can. If a further 20% or 30% drop would force you to abandon the thesis, then you do not own a thesis. You own a mood, and moods do not survive sectors in panic. You need the stomach for being early. You need the patience for the market to be slow. You need the humility to admit the thesis could be wrong, and you need the discipline to separate price damage from business damage. That is what this kind of investing asks of you. The reward, if you are right, is that you get paid not just for being correct about the business, but for being emotionally available when everyone else was psychologically absent. That is always where the best deals live. So if you want the plain Buffett version of the entire story, it is this. The market looked at AI and decided a lot of software names belonged in the graveyard. I looked at the same fear and asked a different question. Which businesses are being priced like software skins, when in reality they own enterprise plumbing? Monday is one of the strongest answers I found that does not make it riskless. It makes it interesting. And in markets, truly interesting usually begins where popular certainty ends.